Okay, we'll get started. Good evening. My name is Brad Olson with Oaktree Financial Services. I'd like to welcome everyone to our quarterly update on what's going on with the economy, a little bit about what's happening with current events. We'll talk a little bit about taxes today. Alfred Hickey is going to join us and go through kind of some of the things happening in the Biden tax plan. So we'd like to welcome everyone and appreciate your attendance. Again, we do these once every basically 3 months after the end of the quarter. So we'd like to talk a little bit about what's going on. First of all, let's get started with talking a little bit about what's happening at Oaktree Financial Services. And again, I get my mouse to work here. Okay, let's see why I'm not paging down. Oh, there we go. A little lag here. First of all, I do want to mention that Oaktree Financial Services, we're in Brookfield. For some people that we have that are joining us that are not clients of ours, we appreciate your attendance. Easy to get to, right in Bishop's Woods. So if you'd like to come and visit us, feel free to stop in and see us at any time. We're here. First of all, this is being recorded, just to let you know. We post this to our website, and if you want to see it in the future, we have it out there. We're going to also be downloading it to Facebook, so other people can have the ability to see this presentation. If you have any questions, we do have a Q&A button that you can press. So we do like to have questions. I know we did one of these earlier today. We had some great questions. So feel free to enter those, and we will cover those towards the end of the meeting. We'll go through and cover the questions. So let's kind of get started. First of all, here's an overview of what we're going to cover this evening. First, a brief Oaktree update. A little recap of economic performance for the first quarter, why the business cycle matters moving forward, what's going on in the business cycle. And as I mentioned, Alfred Hickey is going to spend some time talking about the Biden tax plan. We've had a lot of questions about what's going on as far as discussing what's going on with the tax environment and a lot of the changes that you're hearing about. So we'll spend some time going through that. I'm going to cover a lot of information in a relatively short period of time. And really the goal is this evening is to kind of make you aware of some of the tendencies we're seeing in the economy, to give you an idea of how we're positioning portfolios and looking at what's going on in the investment environment. Now, one thing I did want to cover is just to update a little bit of what's going on with Oaktree Financial Services. Some things we're working on is we do have a new direct calendaring system. We've had clients over the years that we play phone tag trying to set up meetings. We have it set up now so you can go into any of the advisors' calendars and have the ability to book an appointment. So it makes it very easy. Times are blocked out when we're busy. Otherwise, feel free to go in and make an appointment. It lets us know so we can have the ability to do that on a very efficient manner without playing phone tag or email tag back and forth. We are spending a lot of time with our clients with the system we call Equipped, which is the online system that clients have to get into to look at their investments, what's going on in their portfolios, to see statements. It has tax information that is available, and we are working with our clients to make sure that they're using Equipped as we go forward. Another thing, a big project for us is making sure that all our clients, that we have good contact and emergency information as we go forward. In case we have to get a hold of someone, if we're having problems, we can know who we need to contact in case of an emergency for our clients. Also, we've been spending some time on required minimum distributions, making sure that all our clients are aware of what their distributions are, but also spending time doing some planning to make sure that we're doing those required minimum distributions in the best way. We found over the years, a lot of people are actually taking the RMDs or part of their required minimum distributions and going right to their charity. So we've been talking to people to make sure that we're doing the required minimum distributions in the best way. So once you get to the point where you're 72 and have to start addressing the required minimum distribution situation, we want to make sure that we're looking at that most efficient way possible. Last thing we mentioned is we do these meetings on an ongoing basis on different subjects. If you have any input of things you'd like to hear of in the future, feel free to let us know. So let's get started talking a little bit about what's going on with a little recap of what's happened in the first quarter of 2021. It's been a very interesting quarter. It seems like I say that every quarter as we go through it and talk about what's going on with the economy and what's going on with the environment politically and everything else. But we have seen that this quarter especially was a very good quarter. You can see year to date for the Dow, the NASDAQ, and the S&P, the Dow 7.8, the NASDAQ 2.8, and the S&P 5.8% was the increases that we saw for the first quarter. Now, if you look back for 1 year, you can see that the Dow was 57%, NASDAQ 80%, and the S&P 500 almost 61%. Then I also put in here numbers for the last 3 years that you can see. Now, one thing I should note when we're talking about this is you're looking back over a pretty good period of time. The market bottomed about March 23rd of 2020. So when we're looking back at the past year, we are really looking at a great rebound that we had in the markets. We'll talk a little bit about that as time goes on. So when you're looking at this increase, I mean, the 80% is a pretty great number on the NASDAQ, and we see that technology was a big part of that. So I want to put in perspective, don't think this is going to happen every quarter and think this is going to happen every year. This is a very unique time frame that we're looking at from the time the pandemic bottomed until coming back to where we're at currently. I do want to just note also on the treasuries, I did put on this slide at the bottom, you can see what the 10-year treasury, which is kind of a benchmark that many people use as far as mortgages and just interest rates in general. You can see that basically the rate year to date, we're currently at 1.72. A year ago, we were at 0.587. 3 years ago, we were at 2.74. Still at 1.72 as of 3/31. Right now, we're running at about 1.6 as of today. You can see that still relatively low rates on the 10-year. We have seen an increase from a year ago, and that has affected bond values a little bit, but it is something where we still are seeing that rates are still relatively low from that standpoint. The next slide covers a little bit about what's going on with the markets. I like to show this illustration where you can see how over the years we've had ups and downs in the markets. Currently, we can see that if you look at right now, we're definitely at a high. I mean, every time the S&P closes as a positive lately, we've been setting a new record for the S&P 500. But what you can see with the S&P 500, again, it's not a straight line. Back in the tech bubble, we were down some 49% from peak to valley. Back during the whole housing crisis that we had, the financial crisis, basically 57% from peak to valley. Then you can see in this last one, which is a very short one, we were down about 34% from peak to valley. Now, the good news is if you look at the straight line that we've drawn here, you can see that we have recovered most of that. But one of the things I do want to make people aware of, that this is going to happen on a continuing basis. This is the last time that we're going to have a correction. Now, the good news is the correction that we had here was a relatively quick one. Now, when we look back here, I did want to talk a little bit about volatility. You know, one of the things that we watch on an ongoing basis is a thing called the VIX. It's a volatility index. Now, I've put in here various events that have happened over the years. Like I mentioned, the tech bubble, the financial global, basically some of the things that we can see that's happened over the years down to COVID. What we find is we look at volatility. Now, one of the things the reason I put this slide in is right now, when we look at where the VIX is, which is a measure of volatility on a short-term basis, it is relatively low. We started the beginning of the year at around 27. That number now is down to about a 17. So what that's telling me on a short-term basis, that over the next 30 days, we're probably not going to see a ton of volatility. Now, that can change fairly quickly due to the fact that there can be events that happen that allow more volatility in the markets. But right now, we have kind of seen that volatility work its way out a little bit on a short-term basis. Now, when I look at this slide, the reason I put this up, this is a very busy slide. We're not going to spend a lot of time on this, but what I wanted to show here when you look at this talks about various bear markets we've had over the years and various bull markets we've had over the years. Now, one of the things, what is a bear market? Basically, a bear market is where we see a 20% decline in the major index. So when you look at, for example, the Dow or the S&P, what we've seen is, do we have a 20% decline? Now, you can see all the years where we've had bear market downturns, 29, 37, 46, 80, 87, 2000, 2007, 2020. Now, these are bull market runs we've had. Now, one of the things that I've been telling clients is we were experiencing the last, since basically when you look back, we had one of the longer bull markets that we had up until the pandemic. We saw 144 months duration of the market showing the positive trends where we didn't have a bear market. That is quite amazing when you look back historically. By far, when we look at the duration of bull markets, the longest we've ever had when you look back historically. So one of the things that we were looking at, even going into 2020, was we were probably going to see a little bit of a slowdown. Now, we did not expect what we had with the pandemic. Now, when you're experiencing a bear market, one of the things I wrote an article back when we started the pandemic bear market, that basically when you see a bear market, it's going to be caused by, let me go back here one, excuse me here, go down. It's going to either be caused by a cyclical, which is basically the business cycle. It's going to be caused by structural, which is basically what you see when we had the situation in 07 to 09. And then you're going to have an event-driven bear market. So there's three types of bear markets that we look at. One is cyclical, the business cycle. The business cycle is accelerating, inflation starts to come in, the Fed reacts, raises interest rates, maybe they overshoot with that reaction, it causes us to go into a bear market. Structural is where we see that there's too much leverage, we have the financial bubble, there can be things that cause just the structural decay for a period of time that causes a bear market. Then you can have what we had with the pandemic, which is an event-driven bear market. Now, the good news is historically, and why when we were looking and why I looked at this, was I wanted to see historically how long the different bear markets have lasted by classifying them into cyclical, structural, or event-driven. And what we found is event-driven, like the pandemic, are usually the shortest. Now, honestly, we did not know it was going to be as short as it was. Our recovery was relatively quickly in comparison to historical averages. So we did see that we did bounce down very quickly, and we also bounced back up fairly quickly. So overall, we did see that the event-driven really did hold true to kind of its historical perspective of not being quite as long of a bear market experience. But still, we did see a 30-some% drop from peak to valley during that time. But again, why do we talk about this? Is I do want investors to understand this will happen again. This is not done happening. We will see that we're going to go through bear markets. We're going to go through downturns. And honestly, it's good that we have them, because if we don't and things just kept going along and became too pricey, the fall could even be deeper than what it is. Now, what the Fed's job is to try to control the depth of how things go down. That's why you see trying to make fine tuning instead of dramatic adjustments as we go forward. You look at some of the things that we look at from the standpoint of the pricing of equities, for example. Now, one of the things I talk about quite a bit is PE ratios. There's been a theory that price to earnings ratios don't matter the way they used to. I come under the theory that they still matter, because what that tells you is the price of the outstanding dollars of the stock. So you look at the total capitalization that's sitting out in the market of the stock versus the earnings of the company. You divide the earnings into that capitalization, you get what's called a PE ratio. It gives you an idea of how much earnings are happening with that company. Now, eventually, when you have a company, you have to have earnings. If you don't have earnings, eventually a company will not exist. It's just a fact of investing. You're not going to invest in a company that's never going to make money. We've seen over the years like a Tesla and some of those. I mean, eventually, you're willing to invest in a growth company because you think they're going to have earnings someday. And if they start having that, or they have a good chance of having it going down the road, you're okay with it. You'll take a high PE ratio, but eventually you have to see that happening. Now, what this chart really shows us here is historically, right now, we're at about a 22 PE ratio, which we've averaged about over the last 25 years around 16. So we are a little bit high in the PE ratio. So one of the things that we're going to need to see in our pricing of our equities, and this varies holding by holding, is because this is the S&P 500. These are 500 stocks, just a benchmark. That's all we're looking at right here, is what's going to happen with those ratios. Are we going to see that ratio come back down to normal because earnings go up? And it may drive stock prices up somewhat, but what's going to happen is we do need to see earnings to start justifying the price of a stock. Now, the theory is, and why we're not overly worried about that, we do see earnings coming in and increasing as our economy gets back into a flow again out of the pandemic. And that's really the theory behind looking at a higher PE ratio right now. But eventually we do need to start to see those things kind of even out over a period of time. Now, I did want to, this slide really, I thought was kind of interesting because one of the things that we saw in 2020 is that technology really became a big part of investing. The NASDAQ, if you remember, I mentioned that was up 80%, which a lot of the technology falls into that category. Now, when you look at this, this shows three things. It shows the S&P 500, out of all the stocks in the S&P 500, basically 37% of the value of the outstanding shares are basically in technology. When we look at the GDP, technology gives about 6%. We look at employment, technology gives about 2%, but yet it is a huge part of the market. Now, what we're starting to see is we are starting to see a little rotation. Now, this was very logical because what we had is when we went into lockdown, the technology companies really became very prevalent due to the fact that we needed that to develop what we're doing today, these webinars and everything else. So technology, it's going to continue to be a big part. The question is it going to dominate as much of what's going on in the stock market going forward? But it is something as we're looking forward that, you know, I thought it was interesting to see last year, because what we found is that almost 88% of the stocks, or 88% of the return, came from only about 10% of the stocks last year. So when we look at it, a lot of those technology stocks contributed to that, the return on the S&P 500. Okay, next, I want to spend a second talking about deficits in the federal budget. You know, one of the areas as we go forward, when we're talking about the budget, we're really, you know, when we look at our debt to GDP ratio at what we're projecting out for the end of 2021, that we're really looking at a ratio that really is rivaling back to World War II, when we had to really raise a lot of debt to fund our war effort. What we're seeing is that we're starting to see those debt ratios come back to those levels. So when we look at percentage of GDP. Now, is that a bad thing? Well, one thing I'm a believer in, and again, everybody's theory on this is a little bit different, is really the pandemic was a bit of a war. I mean, we had a war against the pandemic. So what we saw is our economy and our infrastructure and our government, which is what they're there to do, really rallied the wagons and said we need to protect our economy and protect people from what's going on with this pandemic. So what we saw is we did raise our debt quite a bit. Now, the question is how much is enough? And that is one of the areas that we're grappling with as a society right now, is how are we going to really be able to take this debt and keep it under control? Now, one of the theories you have is with debt is you can grow your way out of a debt situation, that your economy grows, your GDP grows. So these ratios change because, again, the GDP number is going up. We will see some of that. I mean, we're very confident. And one of the areas as I go through this and we talk about this is you'll find that we are pretty optimistic about what's going on in the economy right now. And there's several reasons why I'll show you. So that will help raise our GDP. We are pretty confident about that. But also we are putting a lot of debt on. And that's where there's going to have to be a lot of discussions that are going to go through with our politicians and our economists to try to figure out what is a balance as we go forward there. Because you can see, I mean, basically, you look at our sources of financing, I mean, we are borrowing a lot of money right now. There's just no question about it. How are we going to fund all the obligations that we have as we go forward? And especially if we increase some of those obligations. And again, whether you know, again, there's a lot of different viewpoints. I read a lot about, matter of fact, I was reading a book on socialism, trying to get a handle on people argue between capitalism and socialism. We're a little bit of both, by the way. We're not all capitalism. We're not all socialism. We're a balance between the both. That's kind of the way an economy works many times, because there's some things that have to be done by the government that the private sector won't do. It just isn't profitable. So we do need to see a balance of that, but what is that balance? And that is something that we're going to debate on for a period of time here. And we will see that to sort out as time goes on. But we are concerned about it, because also remember, we have been funding this debt, our borrowing, at a very low interest rate. What happens when our interest rates go up? Then the debt servicing that we have also goes up, which increases our debt as we look forward. So I don't want to bypass this subject and have people think that this is a non-event. But right now, I'm not overly concerned about it. But we go through 2021 into 2022, it is something we're monitoring to see what these ratios look like. Again, down the road, and this is the children, grandchildren discussion many times that I hear people have, how is it going to affect down the road? Are we just putting out our debt that somebody's going to have to service eventually? Now, when I look at unemployment, the good news is we have seen in April of 2020, we peaked around 14, almost 15% unemployment. We've seen those numbers come down, or running right around 6%. Also, we've seen an increase in wages, which is a positive. We have seen wages come up. Again, you can debate how this happened as far as which political party or which theory actually caused this to happen, but we have been seeing wages happen. Now, we knew, and again, this is the good part about an event driven, that once we get control of the pandemic, which is a key, we did start to see unemployment come down. Now, again, we are hoping to see that, for example, when we start looking down the road, we expect strong job growth for the rest of the year. We should see, unemployment fall to that 4.5% to 5%, hopefully by the end of the year. And going into 2022, hopefully in that 3.5% to 4% range, because there's a lot of the workforce that we have to put back to work yet. But it is something, again, that is important when we look at where things are at currently. Now, I'm not going to spend a ton of time on this slide, but I did think it was interesting to show where our jobs were lost. When you look at this, you can see basically what this is showing is jobs lost, like leisure and hospitality. Basically, that lost the most jobs when you look at the total percent numbers. Now, we've recovered about 58% of those, so only about half of those. You can see with most other sectors, we recovered quite a bit of the jobs. Now, on the government side, we still have a ways to go. I mean, we're still down there. We're not recovering as quickly. But what happens when you can see, so we have recovered in many of the various sectors, but we still have a ways to go in certain sectors, which is good news. I mean, we've seen this recovery happen as far as markets go without these really kicking in yet. So once that happens, hopefully that will help our unemployment come down to those ranges I was talking about as we go through the year. Now, inflation, one of the keys that we're looking at with inflation is what happens as we see different inflation markets. Now, right now, inflation is not a big worry. I mean, we've seen it edge up a little bit, but still well under control. Because I went back, and this slide basically shows different phases with inflation, when you have high and rising inflation, when you have high and falling inflation, when you have low and rising inflation, what's happened to some of the asset classes over the last since 1988. Now, the good news is that we have seen in general that when we're seeing inflation rise, that's not a bad thing, long as it doesn't get too out of control. Because what that means is we're putting people back to work. Again, remember, there's always a supply and demand in all the different areas we're talking about. There's a supply and demand for labor. Now, what happens is if there's a big demand for labor, there's a limited supply of labor, it does drive up wages a little bit, which is good. I mean, we'd like to see people earn more. But then it starts getting into inflation. So the Fed has to try to control and balance all that and make sure when they're putting their policies together that they're not letting inflation get too out of control from the standpoint of accelerating too quickly. And that's where you start to see them look at rising interest rates. Now, the good news is Powell's been very adamant about the fact that we're not going to see tightening on the interest rates. We're not going to see them increasing rates. Now, there's two ways that happens, though. One is the Fed policy, but then there also is just intrinsic, organically, what we're seeing happen with rates. Remember, I mentioned the 10 years eased its way up a little bit. That's just because the market is bringing it up a little bit as we go forward. Now, when we look at the yields, you can see that I put on here basically what's happening. You can see inflation average about 3.62. Right now, we're at about 1.4%. So historically, a very low number. I mean, our yields I have, on a 10-year, when we look at around 1.73, still historically very low. So the good news is this should allow our economy to continue to grow with these rate environment that we have. I mean, a Fed funds rate at 0.25 is a pretty attractive number that we have. So when you're looking at borrowing, why are those rates important? Businesses look and go and borrow money to expand, to do the things they need to do. If they can get that capital very inexpensively, it allows them to grow what they're doing and do it in a very efficient manner. So there still is that ability that we see with that growth from that standpoint. Now, I did want to highlight a little bit about what's going on in the world. One of the things that's kind of exciting that I think that we need to look at in our portfolios, that we may want to look at increasing our holdings of some of the international equities a little bit. When we look back at what's going on, what we're finding is if you look at the price to earnings ratios of basically the S&P 500 versus the non-US based indexes that we look at, we are seeing the price of stocks in a lot of the other developed and emerging countries are giving us some ability, we think, to probably increase a little bit more. Now, usually what happens, I've always stated that a lot of the foreign markets basically trail us about 6 to 12 months as we look forward. So it is an area that we're keeping an eye on as we look at some of the price to earnings ratios of these markets. Want to make sure that we're looking at also what's going on with the pandemic. Any discussion on the economy cannot eliminate what's going on with the pandemic. You must make sure you talk about this. Now, the good news is the numbers have been going in the right direction. The vaccinations are going in the right direction. It looks like we are getting control, but that's not a definite. What we're seeing that we need to make sure that we keep that trend line, and we have seen a little bit of a bump up lately, and hopefully, and the prayer is that we don't see that really stymie what's going on with our comeback that we're having. And again, there's a lot of debate that people have whether how serious it is or how, again, I believe, this is just my personal opinion, we had to take some of the steps we've taken. I don't think that they were, now some people say we went too far, we didn't go far enough. It's a balancing act, and only history will tell if we did or did not. But it was real. I mean, if I've known people that have had some serious ramifications from this virus, and it is something that isn't a serious event. So we did have to take steps to look at it. Now, but don't think it's done yet. And again, I think it's one of the areas that could affect our economy and either stall some things out or change things. So we do need to continue to monitor it. On the interest rate environment, I did want to spend just a second talking about interest rates. This is one of the things that has really hurt a lot of our investors, especially the people that were bank investors over the years. There's just nothing out there on the rate environment right now that provides you any yield. If you've got your money in a savings account at a bank, you're basically just letting them have your money and you're letting them safe keep it for you. It's kind of like a big safety deposit box. What we're seeing is that's not probably going to change anytime soon to any great degree. So one of our big challenges is trying to work with investors to up that yield, either with dividends or certain types of bonds, ways that we can see that we can try to get the yield up. But it is something right now that's been a quandary that we've had. Now, when we're looking at the business cycle, I just wanted to highlight where we're at in the business cycle right now. Basically, we're heading up kind of into that peak area. We've seen a nice acceleration. We're not at the peak yet. We've got room to grow yet, but it is an area where we come out of basically the trough. We start to see expansion. We're starting to head towards that peak. Now, what does that mean? Economic growth is strong. Our ISM numbers are good. Commodities are rising. Short-term interest rates are rising, but not too dramatic. That's a good sign. But we are starting to see them rise a little bit, which is a natural at this phase of the business cycle. Inflation is rising again a little bit, which is good, but not out of control. We've seen bond yields rise a little bit. So basically, the economy is entering, we have to watch, does it get to that overheated stage? And that's when the Fed starts taking action to maybe slow things down. Now, the money supply, I mentioned here, the growth of money supply eventually begins to slow. It's not yet. There's a lot of money out there looking for places to go. So it's something as we go forward, we're monitoring, but a lot of people have stored up money that's going to be looking for places to invest. And again, you can't walk into the bank and get anything. So you're looking at equities, which actually helps the returns on equities because there's a supply and demand for those. So overall, when we look at where we're at in the economy, we're feeling that, we're definitely right in this phase right now. Again, a ways to go before we peak. Now, just some numbers. I'm going to quickly cover these. Housing still strong, weakened a little, but still strong. We've seen if you're buying a house in Wisconsin or you want to sell a house in Wisconsin, now's the time to do it because basically they have auctions for them after they have an open house for 2 days, which I find amazing. So when you're looking at it, housing is still a solid marketplace, which is good because a lot of industry comes out of that. When we look at a lot of the leading indicators are going in the right direction. I mentioned employment, although weakened a little bit with the last one we looked at, still in a positive direction. Inventories, this is a key item. Inventories are something that I've always watched over the years because this tells me of what pent-up demand is there. Right now, we are seeing that inventories are basically down. So when you look at it, we're seeing that when you look at that red line of inventories, they're much below the sales number. So what we need to see is we need to see the economy produce things. We need to see manufacturing. We need to see more industry put goods and services. I had a client that was telling me they were trying to buy a refrigerator. There's like a backlog on refrigerators. You can't get a refrigerator. They want a certain LG one they want. And basically the guy said it's going to be about 6 months before they have that. And it didn't seem like that fancy of a model available. There's a backlog on that. So it's one of the things that we want to watch. So it's good news. I mean, it's good news because we have to fill those inventories. Inflation, I mentioned, is rising, still a decent number when we look back at inflation. So we are starting to see, though it is an issue that we have to address a little bit. Again, doesn't mean I'm not panicked on inflation. It's still a very low number at the 1.4 level, but it is something that we will monitor. We've seen that commodities, get to the next slide here. Commodities, basically, we've seen an increase in commodity prices. And again, not a bad thing. What that means is there's a supply and demand, and there's a demand for production using certain things that we need to produce things. I mentioned my daughter works for a place called Ryerson Steel in West Allis. Basically, they're a steel provider. What we find is she's saying that there's a demand for steel for production and not as much supply. So it's drove up the prices of it. And that could lead to inflation someday. All these things are interwoven. US dollar weakening, but still pretty solid. When we look at our trade and some of the other things that we do, this is where that comes into play. Now, I covered a lot of information in a relatively short period of time. I'll wrap up a little bit at this end, but I want to give Alpha enough time to spend some time and go over kind of what's going on with the tax law changes. So go ahead, Alfred.
Hello, everyone. Just to quickly introduce myself again, I'm Alfred Hickey, another advisor at Oaktree, and I'm also a certified financial analyst. So, me and Brad like talking about all this economic stuff a lot. All right, so what I'm going to be talking about is the potential tax changes that are going to come with the infrastructure bill. So none of these have been confirmed yet in law, but some of them will probably be put forward, though they'll be in a slightly modified way from what we talk about today. So what is the infrastructure bill? It's a true, as it stands now, which again, it will probably change. It's a $2 trillion plan with about $621 billion for infrastructure, $300 billion for manufacturing, $380 billion for the electricity grid, and $400 billion for health and elderly care. It's not completely infrastructure. That's the name of the bill. You know, there's elderly care and other things in it, but just the way that politics works these days, you see more and more that there's these very big bills where they just put everything into. And we'll talk about that in a second. And that's pretty much because that's the only way things are passed. But in a broad sense, it's basically focused on, you know, getting green infrastructure that is, you know, environmentally friendly and also competing with China. So, like I just said, why is I shoving all these things in this one bill? It's because it's very hard to pass things through the Senate if they need 60 votes to pass the filibuster. But there's a thing they can use called reconciliation, which they use to pass budget bills, which they only need a majority of 51. So the Democrats have that majority, so they should be able to pass this. But it kind of depends on the horse trading that goes on with these bills, exactly what will be in it. So one thing which we'll talk about in a little bit will be the SALT deduction, the state and local taxes, which a lot of Democratic senators and congresspeople want to reinstate. All right, next slide. So in terms of raising taxes, so to be able to fund this infrastructure bill, they also want to raise taxes. And they also want to pull back from the Trump tax cuts that occurred in 2017, which was the Tax Cuts and Jobs Act. So the main things this did is it made a single corporate tax rate of 21%. It added lots of deductions for pass-through corporations. So these are things like LLC, where the profit is passed through to you, or the loss is passed through. Lots of changes to foreign taxes. The one thing that a lot of people noticed right away was it raised the standard deduction. So much fewer people are taking itemized deductions, and it lowered the income brackets. And also what this did is, going back to what Brad was talking about when he was talking about the deficit, is this caused an increase in the deficit outside of a recession, which is relatively rare. So I think that if taxes don't get raised this year, they will get raised down the line, just because the relation between the growing deficit and the current tax rate is just too out of whack. That they need to get it somewhat in control, though I don't think it's doomsday, but at some point they were going to need to raise taxes. So the main revenue raising thing is he's raising the corporate tax rate from 21% to 28%, and a uniform tax on foreign income of 21%. So this is kind of the main revenue thing, but this won't really affect our clients directly. So the thing that will be affecting them is the household tax changes. So the one thing that Biden promised on the campaign trail was that he would not raise taxes on people whose incomes were above 400,000. And so this is for households. So for individuals, this is 200,000. But you'll see in here there's some kind of odd things, and that's because of that campaign promise. So one thing is that for incomes above 1 million, he will start taxing capital gains and dividends at the same rate as normal income. And if this is lowered down, if this increases, this will be a big change for investment income and for our clients, and how we structure IRAs and other things like that, other tax advantage accounts. So we'll keep a very close look on how capital gains are taxed. Another big change is that incomes over 400,000 will now pay the Social Security tax. But this is one of those points where it gets a little odd, because so the Social Security tax, also known as the FICA tax, you will pay that up until 137,000 in income. Then past that, you will not pay any taxes on that until you get to 400,000, and then you start paying again. So this is what, if you hear the FICA donut hole, is what this is being referred to. And also another very big thing, which I think some of our clients will definitely have to deal with, is that there's a lower estate tax exemption. So the estate tax exemption after the Trump tax change was 100, let me check this real quick, was 11 million. So they're lowering that all the way to 3.5 million. And so this is not just your investment assets, this includes your house and any other assets you have. So this is much closer to the middle class level. So this is going to definitely affect estate planning for a lot of people. And another thing which I haven't decided yet, but a lot of Democratic politicians want, is to reinstate the SALT deduction, like I just said. So what the SALT deduction is, it allows you to deduct any state and local taxes, which are usually property taxes and income taxes, from your federal tax bill. And in the Trump tax bill, they lowered this to 10,000, where before it was uncapped. And since the states with the high local taxes tend to be Democratic states, the Democratic politicians want this back. So here you can just see a quick example of how this affects you. So if you look at that arrow right at the 200,000 to 500,000 level there, you can see that they would pay on average a tax increase of $2,000, which on the very far line is about 3.4% of their taxes. So you can see that it starts kicking in right around 75 to 100,000, where this really starts to matter. And then there's a couple new provisions in here for tax credits. So they're going to temporarily expand the child tax credit. A lot of people are talking about making this permanent. They also have tax credits for manufacturing, domestic manufacturing. That's part of the competing with China thing, and a first-time home buyer credit. So one thing that I briefly touched on is that the corporate tax is like probably the largest in terms of revenue change in this tax bill. So, but that doesn't affect you directly. So it's kind of hard to know how corporate taxes affect you. Some of them will be passed on to consumers for higher prices. Some of them will be passed on to shareholders as less return. So if you're in the stock market, this could mean lower returns on your stock. So I don't think it will have a very big effect other than a kind of one-off reaction to that change. And then there's kind of some other possibilities that haven't been proposed really formally, but people have been talking at them. So one good one would be a crackdown on tax havens, like a Cayman Island or something like that. And this would just help broaden the tax base in general. And hopefully, people who don't use tax havens who have to pay less than. A wealth tax is something people are talking about, which would be a big change that we'd have to look into. And also ending up the stepped up basis for estates. So this is when someone passes, their estate goes on, the cost basis for any assets they have, so like a stock, will be stepped up to what it currently is instead of what it was originally bought at. So this is actually a huge tax advantage of giving an estate. And they'd also talk about rolling back the pass-through deductions in various ways, which if you are using that, you should definitely pay attention to, because after the 2017 changes, a lot of people kind of optimized around that pass-through deduction.
Okay, well, thanks, Alf. One of the things that when we started to put this together and talking about the tax changes, first of all, nothing is decided. So everything we're looking at is a possibility. Something will happen. There's no question about it. Again, I was mentioning to someone the other day, this has been a debate that's been going on forever of which way to fund our government, either through letting more money in the pockets of the people or taxing and using it through the government. Again, no right or wrong answer. Only history tells us how things work out, but it is something we're looking at that we do need to make our clients aware of some of the things and how it's going to affect how we invest your money, how it's going to affect how you do your planning. Like Elf was mentioning, one of the things I think back again, I've been doing this for about 40 years now, estate taxes. It used to be when I first got in this business in the 80s that estate taxes were a big deal. We had to do a lot of planning to make sure that people weren't going to see a lot of their assets eaten up when it passes on to the next generation. With the limits we had of the 11.7 million, I think it was, when you looked at the basis that you could protect, now we're down quite a bit from that. So there's going to have to be more thought when you look at your total assets, because we do have clients that have done a great job in saving, have homes, things of that nature, that their assets get over that. So not that this is going to affect a lot of people right away. As Elf mentioned, a lot of this is really based on that $400,000 number. We mentioned about the donut hole for the FICA tax, when that gets phased out, when it starts again. I mean, a lot of this is being based on it. Who knows where it's going to end up? And, one of the things that I'm always a little bit leery about, and I've seen over the years, is we always talk about a certain level, and sometimes those levels creep down because we need more funding for certain things that we want to do as a society. So as we look forward, the only thing we can do is react to what the rules are and plan accordingly for those. But it is something that we do want people to be aware of. In wrapping up here, I want to talk a little bit about some of the keys. First of all, there is a light at the end of the tunnel with what's going on with the whole concept of the pandemic. Talk a little bit about here, we are starting to see the talk about truly herd immunity as we go forward. Massive physical support has boosted debt and deficits. What we've seen is that support is working its way through the economy. I mean, the bottom line is when we put this much stimulus in the economy, that is going to help the economy grow. Just a fact of how it has to. Now, how we deal with it down the road with the debt, again, only time will tell. So we are looking at the second half of the year being decent. Job gain could follow as service sectors rebound. I mentioned a little bit about that. S&P earnings posed to hit a new high of all time. So we are seeing that earnings have been positive. Inflation may rise, but we aren't seeing the Fed talk about it in a big way. They remain very accommodative as far as the policies we have. Valuation of the U.S. equities. Remember, I mentioned the PE ratios are a bit high. We do need to see earnings come up, which we do feel that will happen. I mentioned international stocks may offer some long-term opportunities. So overall, if you ask us today, we're fairly optimistic about what we're seeing in the near future. And again, we try to position portfolios. One thing that when I'm looking at investing, I don't think it's going to be a dartboard market where you just throw a dart and hit any stock and it automatically goes up. I do think we need to watch our sector allocations, watch where we're weighted accordingly, and take advantage of the opportunities that we have. Still practice asset allocation. Never have too many eggs in one basket, but take a look and make sure that those eggs are distributed in the proper baskets as we go forward. Now, I mentioned here about, one of the things we're doing is reviews on an ongoing basis with all our customers. And for people that want to take advantage of that, always feel free to give us a call. We're always available for that. Now, one of the things we want to spend a second on here is covering a little bit about questions. Elf, we do have some questions here that I'm going to bring up.
Yeah, I can see them too.
Question. Oh, here they are. Okay, so let's take a look here. First question or comment. It sounds like overall the first quarter was fairly even, but man, I am scared to death over the next 9 months. Massive federal spending, huge federal debt, and people seem nervous. Can't disagree with that. It is a fact that we are spending or planning on spending a lot of money. Now, only time will tell if we do see that turns into earnings. I mean, again, I always remember a long time ago, I looked at two things that drive markets: interest rates and earnings, because interest rates tell you where the Fed thinks we're at. Earnings basically make sure that the company is actually generating profits. We do see those things being a good tailwind to what's happening right now. So over the next short period of time, I think through the end of this year and going into 2022, it does look fairly promising. And remember, we have not even brought back some of the sectors overall. Next question. I wish we had a chart showing whether there has been.
Yeah, well, I just add that in terms of infrastructure spending, I think it's really necessary to do. It's basically 10 years they've been trying to pass an infrastructure bill, both the Republicans and the Democrats. So I think that will be good.
Yeah. Now, again, I'll play devil's advocate. The question is how much is enough? I mean, that's the part that we have to debate as a society. Again, as Elf mentioned, we have a tendency to pack these bills because everybody has something that they like with inside the bill. So the question will be is how will this end up? What is an infrastructure? I mean, that's the big debate that's going on in Washington right now. And what we're finding is both you're getting resistance on both sides of the aisle on what is defined as that. There is a lot we need to build on. There's no question about it. I mean, as Alf mentioned, several administrations have toyed with this idea. Again, hopefully we'll finally reach some common ground where we get something that's through there. Again, there's a question asking about, with a one-sided Congress and White House, are we going to see things automatically pushed through without any resistance? Really, I don't see that. I think you're going to see that we're going to have some logic to this process to a degree. I mean, from what I'm hearing, there's some Democratic leaders that are pushing back on some of the infrastructure, saying, let's make sure we get some control to this. And there's Republicans that are debating the issue also. So hopefully what we will see is we will see some checks and balances. And it's not going to be Pandora for either side, that they're going to get everything they want. I mean, that's the good part about our system that we have. Okay, let me see other questions we have here. Okay, with all the data you look at, I don't know how you keep it all straight. Sometimes we don't. How often would you be reviewing portfolios? Now, that is a great question. And this is a question that we get on an ongoing basis as we deal with our clients. We want to rebalance portfolios on an active basis, but not let emotion drive that rebalancing. I mean, it's one of the things, one of I had one client that we debated back and forth on this, and basically we arm wrestled and almost physically wrestled about getting out of the markets when the pandemic started. This person was totally worried about what was going on. I tried to explain the event-driven, thinking it's going to be a fairly, quick recovery. Emotion drove his decision and ended up getting out, and we got back in, but we left quite a bit on the table. We don't want to let emotion drive our decisions, but yet we need to be proactive to make sure that we're looking at what the business cycle offers us. That's why I'm always going to go back to the business cycle. Look at where that's at. Take all the other stuff into play. But what I found over the years, no matter who's in the White House, a lot of your success or failure depends on what you hit the business cycle. If you come in at a good time, you can take advantage of it. If you come in at a bad time, you may look not very good at what you're doing. So a lot of it depends on the business cycle. So if we monitor that and adjust the portfolios accordingly, because sometimes if you're a 60-40 stock bond person, we may be going 70% stocks. We may be going 80% stocks. On the reverse side, we may drop down to 30 or 40% stocks, have more bonds or more ways that we can protect on the downside. That's our job, is to make sure that we're adjusting accordingly without emotion driving that decision. Look ahead to the second and third quarter to the extent that you can. Alf, I'll let you make a comment on that. What's your feeling about how the going into the end of the year, going into 2022 looks?
Yeah, well, I think it's like you said, when you're talking about the COVID, how it's an event-driven recession, which is very different than kind of any other recession we've had in the past 30 years. So it's likely to be a little strange in terms of you might see some big inflation numbers that will spike up, but then come right back down, as like Brad was talking about, as inventories kind of readjust to get back to normal. And so for that reason, you might see, like, if they're afraid the Fed is going to raise rates or not raise rates, the stock market might be a little shaky. But I think overall, also for those same reasons, the economy should be pretty strong, because people are coming out of this recession without debt, which is very much unlike the 2008 recession. And as businesses start to restock and start going again, it should see a boost to activity. So I think the next couple of quarters, you might kind of see some day-to-day fluctuations, but the medium trend should be quite positive as we get into the recovery, and hopefully, the cases really start to drop.
Well, we must be getting through the end here because I just lost this presentation, Alf. It just totally blanked out on me. I don't know if everybody's seeing the picture of my grandchild.
Hey, it's looking good.
Yeah, that's how we'll close out, I guess, the meeting. It was the picture of my grandson, Callan, who just turned a year old, you can tell, and celebrating St. Patrick's Day. So what happens is that overall, we're excited about what's going on with the economy. We think we got some good opportunities here. We need to monitor it. We're much closer to the peak than we are the valley. So we need to be cautious. We need to watch our PE ratios. We need to make sure that we're monitoring the status of where we're at in the business cycle, and we'll adjust accordingly. Also, too, we'll continue to talk with people about what's going on with these tax changes to make sure that we can adjust what you're trying to do, or at least give you ideas to think of as we go forward. We're running up to about an hour here. I appreciate your time. If you have any questions, feel free to give us a call, and we'll be more than happy to sit down and go through those with you. And I thank you for your time, and thanks, Alf. Great
Yep.
work on
Thanks
the process.
for joining us, everyone.
Yep. And everyone have a great evening.
Yep. Good night.